Hi, everyone. Welcome. It is 6 a.m., half an hour before we're going to open on February 5th. This week is the first full week of the month, and it should be pretty exciting. So last week we ended this just below all-time highs. We did make a all-time high on that Friday session, but we didn't close up there. And we actually didn't close above the previous all-time high, but still a very nice green bar, and everything looked like it was still going to move upwards. There were a lot of forces that we identified last week that made us feel as though we were going to have a pullback or a correction sometime soon. And we were expecting this uptrend to continue for, well, not the uptrend, sorry, but the upward movement. We were expecting it to continue to move up without at least a little bit of a pullback sometime this week or next week. So let's just take a look and see how we're opening up, whether or not that analysis is still valid or if we've got some new information. Let's take a look at our futures first. So futures down and on the verge of not random. So in the NASDAQ, it's looking like we're about 1, 2, 3, 4. So about not even a quarter of a basis point. So a little bit further away for the NASDAQ, but over here, 1, 2, 3, almost 1/3 on the S&P. So it's getting very close to significant, and a little bit further away over here. So about a quarter of a basis points in the Dow Jones. So we're on the verge. Obviously everything is down. So we're opening with a slight negative bias, but we're not quite in the non-random zones in all of them. The only one that's closer on the verge, really on the cusp of it, is the S&P 500. So it could just be a matter of where we open lower, we trade towards the previous close, and then from there, possibly we could move higher. That does tend to be the normal pattern in markets that are going to continue to move upwards. We'll open a little bit down and then move up, and open a little bit down and move up. It would be a very strong market and perhaps nearing a top or going parabolic if we opened higher and continued higher and opened higher and continued higher. So this is normal movement. So far, we're not going to call this a really strong negative bias, or at least we're not going to necessarily expect that we're going to have a down day. It does make it slightly more possible or probable, but we're not going to say break this uptrend that we've been having. We will probably, if anything, we just might retrace a little back to the EMA 8, maybe today, and then back to the EMA 20 over the next few days or week. That's not quite the pullback we're looking for, because that's maybe 3%. We're looking for a 5 to 10% for us to relieve all the pressure that is in these markets. If I look at the DXY, we haven't looked at this in a while. What we see is, I don't remember why we drew these lines, but it looks like it followed these lines really well. We moved down and moved up over here, but this line was actually ended up being pretty accurate also, because it retraced all the way back to the line and followed it down. But since then, we've been moving upwards, and we consolidated around that MA 200 and broke up. US dollar, we don't necessarily go by moving averages, though. We go by the price movement a lot more. Moving averages are a little bit less meaningful in currency markets. So we had this really strong bar on Thursday, movement upwards, and then a continuation on Friday. This is an uptrend. We did have a break of trend right there, break of trend. Absolutely no trace back to it, just sideways consolidation in order to relieve upward pressure. So this is a strong move upwards. It's a strong US dollar. February is usually seasonally a weaker month in the year. We don't expect to make great gains in the indices during the month of February. Last week, we had rotation into the defensive sectors. We were looking at how the small cap stocks didn't participate along with the large cap stocks. There was a lot of reasons that we looked at last week, but in addition to that, now we're seeing the US dollar is actually pretty strong, and then seasonally February is pretty weak. So that's just more confirmation that we are not going to expect great performance out of February. I don't know if we'll break the trend or if we'll pull back and get our correction, but we're not going to expect huge gains and huge moves in February like we did in November through January. So I don't know that this upward projection is going to continue. We may start going something more flat. So we will eventually probably get that break of trend right here. And if that happens, then consolidation or the pullback correction that we've been anticipating. So let's take a look at our other indices. So we have made that all-time high, and I guess what I said earlier would apply to the NASDAQ. The S&P did close above previous all-time highs. It is still looking very strong. We've got to remember that this trend is intact. So even though we're anticipating or the probabilities of a pullback are increasing, we don't want to actually move our portfolio until we actually get a break of trend. So all of that is just very forward-looking. It's sort of like saying, I've got a GPS that tells me there's a traffic jam half an hour before I get there, but when I get there, that traffic jam could be cleared. It doesn't mean that it's going to continue to slow me down when I actually get there. It's looking a little bit too far ahead. So we want to adjust our speed and adjust our situation when we're driving based on what's actually immediately in front of us. Otherwise, we might get into accidents. So that's the same thing with our portfolio. We want to make our actual trading decisions and adjust our portfolio according to our immediate situation, but it's helpful to know the conditions ahead. It's helpful to know that there might be slowdowns, that there might be accidents, there might be weird weather ahead of us, so that we can prepare and it doesn't catch us by surprise when we actually get to that point. So right now we're still leaning positive. We're keeping our hedges in place because of those forces that are at play that make it a little bit more likely that we may see a temporary reverse in direction. And then we'll just make the adjustments or allow our hedges to protect us if we hit those situations a little bit faster than anticipated. Let's take a look at what other forces might be coming ahead this week. So we've taken a look at our futures. We looked at our major indices. Let's take a look at TLT and our treasuries. And it looks like so Friday, we came all the way back to that MA200, and we were anticipating that we may break through it, especially given all of the FOMC announcements, the intention to not cut rates, and the reiteration of Powell that a March rate cut is really unlikely. Then he went over the weekend and went on 60 Minutes, and he said very much the same thing. So it looks like we're gapping down quite a bit at the open for TLT, and that puts us below all of these moving averages, the MA200, the MA50, the EMA8, the EMA20, and we are going to probably from here start heading much lower. We'll take a look at what the Fed Watch tool says in just a moment. But this is a good sign that we are probably going to move down or test these lows right here. And if we break through that, then we're going to go much lower. So we want to watch that very carefully. A few day or short term trade idea is to short the TLT down to this level. Since we gapped so far, it's not as tempting of a trade anymore because we've basically, if we gap down here and start trading lower, then half the move is already gone. So we'll see. Maybe we'll have some time and play with it in option strat today. But let's take a look at, let's finish our overall picture first. When we look at the Fed Watch tool, is this March? This is March. Let me refresh this. Yeah. Okay. So we've been talking about how Really, the probability I felt should have been 30, below 30, maybe below 20%. Now we're saying a 17.5% chance of rate cut in March. So this looks far more reasonable than the last several months that we've been talking about this. So finally, the market is moving into rationality and agreeing with the actual situation. Back in December, we were at 85, 90%. And then finally now we are at a reasonable probability. So that's going to figure in. That's probably one other factor in why this is gapping down. And then let's just take a quick look at May. So May, to me, is still looking a little too irrational. We were pricing in a 66, 67% chance of a rate cut in May. I put it closer to maybe 30, 35%. So we may be in for a continued movement downwards if the market continues to return to rationality. So if this comes down, then that's going to put pressure on QQQ. If it breaks below these lows, that's going to be a huge amount of pressure on the QQQ, and that will start to bleed into the SPY and drag that down as well. Maybe not the Dow Jones. The Dow Jones has been doing very well and has been very steady, and we have seen movement into defensive sectors. So it could just be people shift their money away from risk and go into defensive sectors and not necessarily pull their money completely out of the stock market. If they do that, where are they going to put it? They're going to put it in the bond market? No, that's going down too. So those are traditionally the two markets that pass money in between each other. And do you pull it out and put it in your savings? Well, we still have high inflation. It's just not at 2%. It is coming down according to the official data, but then there is starting to be reports in the kind of, you'll probably never see it at the forefront of media, but in the passing along amongst banks, amongst the insiders, we're starting to see reports that that the Bureau of Labor Statistics may be kind of fudging their numbers a little bit just to make the current administration look a little bit better, especially going into an election year. So I don't know. That's more kind of the dark corners of Wall Street and the backroom type of dealings. We don't concern ourselves with that because whether or not it's true, it's not going to affect the way that we trade. We trade exactly what is immediately in front of us and exactly how the market is behaving. Is there influence on that kind of stuff, from that kind of stuff on the markets? Maybe yes, maybe no. What doesn't change the way that we react to the market. Okay, so maybe the analogy, if we use the analogy that we used earlier of the traffic, well, is that huge traffic jam? Did they do it on purpose? Did they just shut down 2 or 3 lanes just to force a big traffic jam? Did someone, if we're going to go deep into conspiracy, did someone purposefully crash their car so that we could shut down these lanes and that everyone would be stuck in traffic for several hours? It doesn't really matter. You're stuck in traffic for several hours. It doesn't really matter how or why it developed, or if someone purposefully did it, or if there's some conspiracy behind it. The situation is the situation. And we trade the exact same regardless of the why. So some of my students, they may remember that oftentimes I never question why. I don't care about the why. I don't care how it developed. I care about the situation immediately in front of me. When I was trading $200 billion every single day, sometimes 5 minutes before a market close, I would have an assistant run on me, Kane, this situation, and then I would say, hey, stop. I only have 5 minutes to trade. Tell me what the situation is. Oh, we're under allocated. We didn't trade $100 million that we needed to trade. Okay, that's all I need to know. I don't need to know why. I don't need to know how. I don't need to know who's to blame. I don't care about any of that stuff. I only have a couple minutes and I have to trade $700 million. So let me take my action first. And later, when the market's closed, we can talk about how this situation developed and how we can prevent it in the future. So how we got to this situation doesn't matter. What matters is how this market is playing out. That doesn't change the way that we trade. So just because we have all these news items and we have these, backhanded dealings, well, that exists everywhere. So we can't concern ourselves with that. We got to concern ourselves with the situation at hand and then trade the situation that we have. So the ones that we know about that have clear impact on the market rather than the ones we don't know about, and we don't even know if it has an impact on the market. So the ones that we know about and have clear impact, they'll show up on the economic calendar, they'll show up on the Fed Watch tool, they'll show up in and no matter what, no matter if there are backhanded dealings or not, it will always show up in the price and in the volume. So we rely on those things, and then we don't have to worry about all the other stuff. So let's take a look at our economic calendar and see what's going on here. So that's interesting that they put on this report. They highlighted some things from the 60 Minutes interview, I guess. That's really interesting that they did that. Nothing here. A Fed speaker, a whole bunch of Fed speakers this week. That's kind of unusual. I don't know why there's so many Fed speakers speaking this week. It could be an attempt at influencing something. It's just strange to see so many of them, one after another, day after day in the same week. That's kind of weird. Plus, what are they going to say that Powell hasn't already said in the FOMC conference and on a 60 Minutes interview? So something that's a little weird. Okay, so that's a little weird, but it looks like there's nothing else. Really, it's just a whole bunch of Fed speakers. Petroleum status, international trades and goods, jobless claims has been a nothing burger for over a year now. So really, there's nothing. That means if there's nothing on my economic calendar, that means the earnings are going to play a heavy role in the markets, as well as the overall, just the trend in the market. So earnings is, we have much broader now. All of the FANG stocks, the Magnificent Seven stocks, those have already reported. So we're going to get a much more broad spectrum of companies reporting. We're going to get to see a deeper look into how the American economy is doing based on earnings. And so we got like Cat is a really big name, McDonald's, Tyson Foods, Eli Lilly. So those have also, we have consumer staples, we have industrial, agricultural, food, we have drugs. There's a whole bunch of them. There was Ford, there's another drug company, we've got Disney, we've got Fox, so we've got media and communications, Fortinet, internet security. So it's all over the place, and they're large companies and large and influential companies. So we'll see how well their reports are and how well they're doing. And if they're continuing to be strong, then we'll see strength in our indices. QQQ might have a little bit harder time because it's mostly tech and discretionary. So we won't have large entities, like huge market cap entities like Amazon, like Apple. Well, Apple dragged us down, but like Microsoft and those companies to pull us up and rescue. So the whole thing about the Magnificent Seven was their earnings, the AI stocks, the semiconductor stocks, they were so strong that they were dragging the S&P up. And without those, the S&P would have performed at like a 2 or 3%. But with the Magnificent Seven, just seven stocks, we moved up something, I think it was 30 something percent. So they have a huge impact, and we're not going to, they already reported. So we won't have these huge market cap companies to be able to pull us up if we see anything weird in the rest of these companies over here. You know, the potential for downside movement is a little bit higher for the potential for upside movement. But if across the board they're doing really well and strong, then we'll see this trend hold and continue, at least for this week, because there's really nothing going on this week. There's nothing here. All we've got are earnings. So they're going to be the major player or the major influence in the markets this week. So we'll watch those very carefully. We'll see how our price action develops and whether or not the volume agrees with it. And for now, we're pointed upwards. We're going to keep on leaning to the long side on our portfolios, but keep hedges in place. Maybe refresh our hedges. I will take a look at that in the aftermarket, see if we need to refresh any of our hedges, and just make sure our portfolio is protected, because we are seeing more and more reasons why this market might make a little bit larger of a poor correction sometime soon. Okay, so I've been talking really long, much longer than usual in the morning. It's less than 10 minutes to a market open, so we will end it there, and anything else that comes up, we'll talk about it in the aftermarket session. See you guys a little later.